Restricted stock units or RSUs versus stock options. If you are given an equity compensation package and you have to determine which one of these to pick, this video is for you. If also you just have restricted stock units or you have stock options, I'm going to be going through some calculations to determine or at least show you how you can calculate what you can expect from an income level sometime in the future, and maybe how to think about the differences between the two of them. Like I said, I'll be going over examples so it will make more sense in detail, but just from a high level, restricted stock units or RSUs, I want you to think of as a paycheck, but instead of receiving cash, you receive stock in your company. So I could give you $1,000 paycheck, or I could give you $1,000 worth of stock, and then you can either decide to hang on to the stock or AKA do nothing because you're probably given the stock. So if you do nothing, well, you own the stock, or you could sell it and go buy a car. You could sell it and then diversify into a different holdings or a different brokerage account. It's completely up to you. But instead of receiving a paycheck, you are receiving stock. One of the common misconceptions is believing that it's taxed differently. It is not. It is taxed the exact same. So you are given a paycheck and you take out your federal, your state, your local tax, all kinds of the payroll tax, etc. Same exact thing for stock. But what they usually do is that instead of receiving the full share, maybe I give you 1 share of stock, you're actually only going to receive like 0.7 of the stock because the rest of the stock was withheld for taxes. So for all intents and purposes for this conversation, just assume this is a paycheck, but instead of receiving cash, you are getting stock. Now, of course, if you decide to hold on to the stock, then you could talk about the difference in taxes versus long-term capital gains, meaning you held the stock for more than 12 months, or short-term capital gains, meaning you sold the stock in less than 12 months. But we're not going to get into any of that. I'm just assuming you're receiving the compensation, and that's really where the story begins. Now, stock options are quite a bit different. As the name implies, this is literally giving you an option to purchase the stock at some time in the future. You don't have to exercise the option, but you have the ability to. So the idea around stock options is that on the grant date, on the day that they give you the equity comp and say, congratulations, part of your money is base salary, part of your money is in this equity compensation, and you're receiving these options. And you're saying, okay, are they worth anything? Probably not at the moment that they're granted to you. But as they vest, meaning that they're given to you, meaning that you can now exercise them, you have the ability to purchase the stock. The idea is that the stock is going to go up. So if your stock price is $100 right now, and you have the ability to purchase it at 100, that'd be really awesome if the stock went up to 150 or 200 or 250. And if the stock is trading at 250 sometime in the future, and you have the option to purchase it at 100, well, you can, all of that difference, all of that delta, all of that growth is actually the compensation that you're going to receive. That's where you actually get paid. So there's a little bit of risk there, right? Because you have to have the stock go up in order for you to receive some type of compensation. There has to be a delta, there has to be some growth, which is totally different from the RSU, because if the RSU, even if the stock doesn't grow, it just stays the same, well, you're given the shares and you can cash those out. They're in your bank, they're in your pocket, you can do whatever you want with them. Meanwhile, the option, if you can buy it for 100, but it's trading at 100, you're not going to receive any delta or any growth or any compensation or any above and beyond value. So potentially the stock option could be worthless. So I currently have a client that works at Tesla, and I already ran all the numbers, so this is a good excuse to make this video. They had $380,000 of equity compensation. The current stock price is $296, and they had to make a decision between taking RSUs or taking stock options. So let's just kind of walk through some of the fundamentals. If they chose 100% RSUs, the grant value of $380,000 divided by the current stock price. Usually they take the average over the last 30 days to get to a stock price, just in case there's a lot of volatility there. And then they'll give you a total amount of RSUs that is equal now to your equity comp package, and that they're going to slowly vest over the vesting schedule. I mean, they're going to be made available to you to buy, sell, keep, do whatever as they vest over oftentimes a 3 or 4 year time frame. Now, on the stock option side, it's relatively similar. So often they'll give you 3 times the amount of stock options as you have RSU. So a lot of times the calculation is very similar to get to the RSU total. And then the stock option will just be 3 times more because there's significantly more risk. We'll get to that in a little bit. Now, on the grant date, though, basically what you're going to receive is a option that says, hey, this is what the strike price or the exercise price is going to be if you decide to use the options, aka that exercise price or strike price is really just your optional purchase price sometime in the future. So like I mentioned earlier, you're hoping that the stock is going to go up so that sometime in the future you can buy it at a major discount, and then that difference is going to be the equity comp that goes into your pocket. So now that you've picked which ones you want, RSUs versus stock options, or maybe it's a combination of the both, we can fast forward 1 year, and let's say it was a 4-year vesting period. So that means that only 25% of the shares were vested. So let's take a peek at the RSUs, for example. It's a little bit simpler. You received 1,285 RSUs. Well, after 1 year, after 25% have vested, you simply now have 321 shares that you can keep or you can sell and do whatever you want with the cash. Same thing goes for the options. You have your total amount of options divided by the vesting schedule, and here are the amount of options that you can exercise if you choose to do so. Now, this is where things get interesting, and you might need to do some simple math to determine how much risk that you want to take. So in the first scenario, let's just assume that the stock price stays flat. It doesn't go up or down at all. So the stock price at the vesting schedule was 296, and now it is 296 1 year later, and you received the 25% of the value, so 321 shares. So 321 times 296. On the RSU side, you now have $95,000 worth of stock that, again, you could sell, you could keep, you could do whatever you want. You could sell that and go buy a Tesla car if you wanted to. Now let's dive into what you have on the option side. So remember, the option is really the option to purchase the stock. So you have the option to buy the stock at $296 for the price. And how many shares do you want? Well, you have 964 vested shares. So if you wanted to, you could buy 964 option shares at the price of $296, which would cost $285,500 to purchase. Some cases you actually have to come up with the money, most cases not. I'll explain that in a second. But let's just keep going on with the scenario. So you bought these shares for $285,500, and then what price could you sell them? Well, the stock is currently trading at $296, which is what you bought it for. So you sold it. So now you could sell it if you wanted to for $296, and that would leave you with exactly a $0 profit. So your equity comp would literally be worthless. In this case, you would not exercise the option because the option is totally worthless. So I hope that starts to stress how risky these options are, and that there's a good reality that they could potentially not be worth anything. So let's move on to scenario 2 and assume that the stock price grows 50%, and now the stock currently is trading at $444. So the RSUs is very simple. You have 321 shares, multiply it by the share price, and your shares are now worth $142,500. Congratulations, you already paid tax on it, you already paid state income. Go ahead and cash it out as if it was paid to you, just like a regular bonus or a paycheck. Now on the option, remember the first thing we have to do is purchase them. You have the option to buy it. So you have your 964 shares, you have the option to buy it at $296, and that would cost $285,500. Fortunately, the stock is selling at $444. So if you sold the stock, you would actually receive $428,000, giving you a profit of $142,500. Yes, exactly the same amount that you would walk away from if you had the RSU in this scenario. And moving on to scenario number 3, assuming that the stock price doubles or grows by 100%, all the way up to the stock price of $592. RSUs, you know how simple that is. You just multiply it by your RSU share amount. You have 190,000. That's awesome. You can cash it out. You already paid tax on it. On the options, step 1, as we have in all the other scenarios, you have to purchase the stock. And then the second step is then you can turn around and sell it. Now, this is where the leverage of having additional shares is really starting to shine, because you can sell it for $571, meaning that you're walking away with $285,500. Now the options ended up being significantly more valuable than the RSUs. I did want to highlight that in a lot of cases, especially with Tesla, you do have the ability to purchase. You don't actually have to come up with 285,000 to purchase the shares. They call it a cashless exercise because what they're going to do is look at how much are the shares worth, and they're just going to take that out of the sale price. So you don't actually have to come up with 285,000. However, sometimes with some incentive stock options, especially for privately held companies, you literally do have to come up with the cash. And I have some clients right now who are literally saving into their emergency fund, into a brokerage account, into their bank account, trying to pile up enough money so that they could potentially purchase the stock and exercise it in the case because they actually need the cash to buy the stock and then turn around and sell it. But most publicly traded companies are not going to force you to come up with the cash. They just allow you to exercise them and they'll give you the difference. One helpful exercise I did with this client was to calculate the break-even price between the RSUs and the options, and then found how much accumulative total return it would take. So we saw 50%. That was true in that example. 50% rate of return ended up being that you walked away with 142,500, I believe it was, for the option or the RSU. So that was your break even. Now, if you're thinking to yourself, well, I don't know how long I'm going to be at this company, it might make sense to do some type of rate of return analysis. So for example, if you think that the stock is going to grow at 5%, it might be worth calculating how many months, or I guess I could just quick divide this by 12 to give you years of how long it would take to break even. So if the stock is growing at 5% per year, it's going to take 8.1 years for this thing to break even with the RSUs. That's probably not worth it. However, if it's growing at 20% per year, all right, wow, the break even analysis is in 4 years. That's pretty awesome. In a lot of cases, RSUs or stock options will actually expire in 10 years. And if you leave the company, oftentimes they'll give you like a 30 to 90 day window where you actually have to exercise them. So if you're unsure that you're going to be staying at this company for a long period of time, you should absolutely factor that into your analysis from a risk standpoint and maybe push you more towards the RSUs, which is just going to be cash in your hand. Hopefully you guys found this video to be helpful. Feel free to reach out if you have any equity comp questions. I love talking about this stuff, and happy building wealth. Oh, and I always forget, I'm told if I want to grow my channel to have a call to action. So please like and follow for more financial planning tips. Thanks.